get Brooks.
Hey, Bryan, how are you?
Good. How are you, Shannon?
I'm doing great. Thanks so much for agreeing to kind of come on what we're calling our new podcast, because I'm sure, as you know, Mark and I had earlier in the year in 2020 started a podcast called Brooks, where we were going to kind of talk about, being a married couple and working together and all of our travels and adventures and different things like that. And obviously, the world that we're living in now, this is being recorded on April 13th, 2020, and with the virus and the pandemic and things that are going on, we had to dramatically shift, but we didn't want to kind of give up on the podcast. So we decided to take a whole new spin on it and kind of reach out to people that we were connected to in the community and talk about how it's affecting everybody and different ways to kind of, cope, better educate ourselves on what's going on in the marketplace. So I'm very grateful to have you on here with me to kind of talk about the lending side of things. So I'll introduce you, obviously, Bryan Meredith with Envision Capital. He is a very dear friend of Mark and I's. We adore him and his beautiful fiance, Gayleen. And he's one of our trusted lenders. And those of you who have done business with us and know a lot about the Brooks team, we let very few people into our inner circle because our clients are extremely important to us. And Bryan is definitely one of those people on the front lines in the inner circle with us. And we have great respect and trust for Bryan. So I'm glad you're here today. So
I'm glad I made it. I made it to the trusted circle.
Watch it. Be out as fast as you were in.
That's right. Out.
Okay, so Bryan, really quick, just tell us a little bit about yourself, a little bit about Envision Capital, things like that.
Sure. So originally from the East Coast, sort of leads itself to be kind of what my sort of drive and my work ethic is in that sense. I'm always kind of go. I went to college here, so that's my affiliation and sort of my segue to being in Minnesota. After college, went back to the East Coast and was working in pharma, and I just kind of hit the wall on it. And I was like, I got to find something different, needed better quality of life. So I was like, where am I going to go? Minnesota. And somehow was able to convince my fiance to come with me. And
bless her, because that is not an easy transition.
No, not at all.
She's a spicy, beautiful Latin woman living in Minnesota. Wow.
Yeah. Says is exactly what she thinks, but
Hey, you can't fault her for being honest. She's definitely not Minnesota passive aggressive, and I think it's one of the things I love most about her. So
there's nothing passive about her, that's for sure. So have been living here for about 3.5 years now, again, and transitioned to the lending side in order to sort of make my way back as a new career. But I am an economics major in school and double majored in both business administration, econ, and minored in accounting. So kind of leads itself into being able to like kind of fit right in with kind of what this world is and, sort of the passion as to what that is as well, being able to kind of leverage some of that stuff and that information and have it translate and be able to give that information to other people and really synthesize it and break it down so that way it's understandable, right?
Yeah.
Because I think that's kind of a big deal.
Yeah, I would agree. I always say that every time I meet you for lunch or a business meeting, I leave so much smarter, and I'm very appreciative of you and your knowledge. To my clients that are watching or seeing the podcast, Bryan is featured every month in our newsletter. You do a really great job with that, so I really appreciate it. You're very knowledgeable, fact-based, so that's fantastic.
Thanks.
Yeah. Okay, so we might as well just kind of jump right into what we're seeing right now. I know you and I had kind of talked a little bit before we started recording the podcast about the Minnesota Association had released this morning on April 13th the 2020 March housing report for the state of Minnesota, and it actually looked fantastic.
Yeah, it looked awesome.
It was really great.
Yeah.
Kind of the ray of hope that we needed. It was saying new listings year over year from March of last year to this year were up 13%. Our days on market are down to 57 days. Closed transactions were up 12.3%. But as we both know, and like you said, real estate is a cyclical business and it tends to ebb and flow. And we both know that everything we see comes in 90-day cycles. So I'm a little hesitant to jump with joy because I think that the next 2 months, or April, May, and June will really kind of start to show what the pandemic has done to our local market. Because when I went back and looked, I saw that the week ending in March 28th, into the first part of April here, we were actually down 5.8% in listings. I think it says inventory is now down 7%. So just kind of want to get your take and what your thoughts are on after seeing that report and kind of discussing it with me.
Yeah, I mean, it wasn't a surprise that the numbers were up, right? Because we're really kind of pulling through from January, February, and what does that look like, right? So just as essentially what you were alluding to is that, we have a time lag as to how that stuff kind of filters through from an economic cycle, right?
Uh-oh. Okay, so we're back. We had a little bit of technical difficulties. Welcome to the new normal, right? Bryan, flew to another location. You looking good at the office now, huh?
Yeah. So much for social distancing at the office.
Is your office busy?
There's a couple people here, yeah.
Yeah.
We're essential. We're essential.
I was just gonna say that being essential, we're open. Our brokerages are open as well. Obviously, practice safe social distancing and bring your disinfectant wipes and everything will be fine. So, all right, kind of getting back where we left off, we were just kind of finishing discussing the 2020 Minnesota housing report that came out, talking about how things are kind of cyclical and kind of what your thoughts are on, we had kind of said that it might just be a little too early right now to predict how the pandemic has influenced the market. So kind of thoughts on that.
Yeah, just that, ultimately that pull through on those numbers will eventually kind of trickle in, I think, April, May, right? But, it's like, okay, so we said 5% decline in, what'd you say, listings, right?
Yeah, yep. So listings were down 5%, new listings taken,
Right.
Twin City Metro, and then overall inventory went down to 7% as well.
Okay. So, I mean, if you look at that in real numbers, though, what does that equate to? It's like 5% is, 5% is not a staggering number if you think about how many people got laid off within the context of the past, 3 weeks, right? So if we're talking about, unemployment levels over 10%, but, all of those numbers are really only kind of throttled by 5. I think when you kind of shuffle those numbers around and you kind of put them in contextual aspect, I think it's actually still pretty strong, right? I think people are probably still just waiting kind of to have the market be a little bit less uncertain and kind of what does that look like moving forward. I think if it elongates, that will run into some serious issues, but I think that we've kind of come out the other side pretty quick as far as like the economic stuff, as far as what the government's done in general, just to kind of get us right-sided as far as being upside down, right?
Yeah, I totally agree with that. And how I've kind of looked at it and discussing with my clients, especially my listing clients, really right now, I feel like it's more kind of like the winter months. We're very seasonal here in Minnesota, obviously. And just kind of the slowdown feels very similar to, I always say Thanksgiving to New Year's. We definitely see a decline there as well. So it's almost like the market's responding in that same way. We're just not seeing the tick up that we normally see this time of year with the spring market. I always say that Parade of Homes, that is our true kickoff. That's how I feel. That's how we've seen it in our business. And with that being canceled as well, definitely people are just kind of, they're still out there though. we're still seeing showings. Last week alone, I think Jeff said that Angle and Volkers, we have like 65 licenses, and there was like 283 showings. Our advisors showed 283 properties last week. Like, that's incredible. So there's definitely buyers out there. Kind of let's kind of dive into a little bit about the mortgages. Obviously, we've talked about this at length because we do have buyer clients right now together, and how things are getting a little bit tighter and what people should expect as far as that goes.
Sure. So first and foremost is that a lot of the sort of overlays of what they did just to kind of restrict some of the credit lines of what people can actually apply to and qualify for have been throttled a bit. So, we're looking at FHA that's got to be under 50% now. So you used to be able to go up to 55. They're even saying now that's on an exception. So you actually have to be at 45, less than 45%.
Debt to income, right? You're saying
debt to income ratio,
okay.
Yeah.
Yep.
Jumbo lending has kind of gone out the window and is, from a bank liquidity aspect, they're really withholding those funds. I mean, Wells Fargo has been, unless you have $250,000 in relationship assets with them, they're not going to do anything for you in the jumbo market, which is a huge deal because they have a ton of cash. But it just kind of shows you where their thinking is as far as where they want to be from a liquidity aspect. So jumbo has been really hard. Anything that's kind of like investment stuff has been really hard. There's even been some mortgage insurance companies that are saying that they're going to pull back on some of the investment aspect of being able to kind of say, instead of really getting there at 20%, and if you were trying to get to 15, which some lenders will allow you to do, that they're not even going to insure that anymore. So it just kind of shows you the scope is kind of reeling that stuff in, and really making sure that A, you have a job, and B, that you can afford it, right? And so part of the A portion is that they do a verification of employment, and then now they're making you get verification of employment again after you sign your note to show that you are still currently employed. So they're doing trailing docs on loan documents, and if you're not, they'll essentially call the loan on it. So you could be in a really funky position as far as them calling the loan or putting you into forbearance that you're not necessarily trying to do if you don't. So just making sure that you kind of keep that employment through the first week of when you actually close on a house.
Yeah. So let's kind of talk about that too. Like, let's say you are, I'll use a specific example. So I have clients that are building. I did not represent them on the build side. I'm representing them on their list side, and both of them became laid off. We did not put their house on the market as of right now. We are going to have to withhold. Unfortunately, the builder is saying their deposit is not refundable. They will not get that money back, which is very terrifying because if you've ever built new construction, it's typically anywhere from 20 to 30% down. But regardless of that, what are you seeing? Are there ways for people in that scenario to either defer things out, or how do you kind of recover from that? Like, I kind of spoke to them briefly about where are we going to be? They will get their jobs back eventually. Do you just try to defer it out longer, or what are your thoughts on that?
Yeah, I mean, I think if you're furloughed, right, then there's a light at the end of the tunnel, right? Whereas if you're laid off, you're just like, that's it, right? You got to kind of go out and start the process again. Lenders are allowing for forbearance, but forbearance has been kind of wonky depending upon who the servicer is. And essentially, if you're going to forbearance, it's not going to be a negative mark on your credit. So they've already showed that, they've put in the law saying that you can't actually have it be something that's negative against you because it's not something that you've necessarily done, right? Somebody ate a bat. You can't control that, right? And like,
yeah.
Some crazy.
It's not that you're overspending or just not making your payments, or
you can't control if somebody decides to be weird and eat a bat, and then whatever. It's like not your fault. So it's like it's there. So the forbearance aspect is actually kind of a pain because either they're going to do it in a 6-month or a 12-month run. And either they're going to do it where you have to do it as a balloon payment at the end of your forbearance period, which how are you going to do that if you haven't had it? Right.
I don't think a lot of people understand that if your mortgage payment is $2,000 a month and you go 90 days and then that 90 days is up, you owe that right then and there.
Right.
Like, so it's not like they're tacking onto the back of your loan or they're going to refinance you or things like that. You know, I saw a really great kind of, you know, meme popping around about it that was really good that showed, you know, like, okay, yeah, now we'll divide it up over the next 12 months. Well,
even the next 12 months though, if you think about kind of what that forbearance period looks like, that's still a lot of payments, right?
Money, you know, so it's $6,000 and then they try to divide it up, and then all of a sudden your payments go up by $500 a month. And that if you have you know, that higher DTI ratio that we just talked about, that puts you above where you're comfortable anyways. So
right. And it's kind of counterintuitive, right? It's like, oh, I'll qualify you at X, but if you could afford a $500 more a month payment, then you probably would have reached for that extra, you know, the additional house. So like, it kind of puts people upside down on what's kind of going on. They have started to kind of roll out some of the stuff where they're deferring it as a second lien against the property. So essentially they're going to have it roll backwards, and that eventually you're going to have to pay that off, but it'll come at the time of payoff. So if you ever like get to the end of your loan, essentially those payments are just deferred as the principal loan balance in the future. And so they're starting to roll out some of those programs just to kind of not make it be so punitive, or not necessarily punitive, but like difficult to repay. Because obviously if you can't afford to pay back that $500 or whatever it is additional per month, you know, then that's when you start talking about like foreclosure and stuff. And that's actually what would really crush the market.
Yeah. Yeah. I mean, it'd be 2007, 8 all over again.
Mm-hmm.
You know, but I don't really like, even as I say that, I don't really, you were kind of starting to see that fear and people kind of compare this to 2007, 8, and they're very different markets, right? This isn't a housing crash for one. We don't have the inventory that we had back then. For a lot of people that don't know this about me, I started my residential stint in real estate, if you will, because I came from the commercial side. I started November of 2007 on the residential side.
Great timing.
So it's like, oh, I just quit my, you know, one side corporate job, joined another, and went into residential, and the whole market, I mean, literally the bottom fell out. So, and I don't really feel like that's the same here. And I think everybody is saying the same thing, you know. It's going to be more of this like V curve, right? And like it should come back eventually. It just is all going to take some time.
Yeah, I mean, I guess it's kind of more of like how they're saying more of like a U. I think some of that has to do with how long specifically we are out of, like, the economy is basically on hold, right? And you're correct. It's not the same as 2007, 2008, just because those were bad assets that people were selling and inflating. And that just really had no market value or relevance within the contextual aspect of the market itself. And when those went bad, they went bad completely because people were being dishonest, and on all levels, you know, not just, you know, kind of at the mortgage level, but like way beyond that. And the thing is that we would never have been able to even originate mortgages if people weren't willing to buy them on the secondary market, right? So if there was no appetite for that risk, those would have never been sold. The difference is that we have a pretty strong guidance from the federal government that they're going to continue to provide liquidity in the market and buy, you know, mortgage-backed securities and do all the things, because they realize that the fundamentals behind it is not necessarily upside down, that it's actually there. It's just a question of how do you get people to be able to work to repay the stuff, right?
Yeah. Yep. Yeah. Yeah. And I've had a few conversations, and it's kind of worth talking about, with buyers that are like, well, that are still well qualified. They're still able to buy. They're still able to go into the marketplace, but they're like, well, we're just going to wait because we think that we're going to get such a drastic discount when this thing kind of starts to pull ahead. And I just don't feel like that's the case. This isn't again, the housing market isn't crashing. Everything's just on hold. And right now, I actually have been seeing it drive the prices up because there are fewer buyers. There's fewer there's still the same amount of buyers. There's just not as much listing inventory. Therefore, the demand changes significantly. So, if I just feel like that's not the best way to look at it right now. If that's kind of what you're holding out for, it might actually impact you far worse.
Right.
If we do come out of this strong, and which we hope to do, what's going to happen is we're just going to have a delayed, in our market, spring market, right? So it'll turn into late summer, fall, and everybody will kind of jump back in really quick, and we'll end up in the same multiple offers in that lower bracket, things like that. So,
right.
I just don't see it being like all of a
I don't
sudden.
either. I think it would be a different discussion if we see this extend through May. Okay. I think I think we'll have a very different opinion as to what that might look like moving forward if it elongates itself, right?
Yeah.
Just because the ability of individuals or businesses to come back after 90 days of not being able to have any revenue, and what does that look like, and being able to jumpstart those again. Granted, there are, low, interest rate, small business loans that are going out to people, but it's, all of that liquidity takes a long time to kind of get into the market. So I think that if we start to see this extend beyond kind of the May time horizon, we're going to start to run into some bigger issues, which is why everybody keeps targeting that May 1st kind of jump off for people to be able to start trickling back in and start, actually having people back in the economy.
Yeah, and I think we were discussing that economists are kind of maybe predicting like a yo-yo.
Yeah, so like more of like a W, or like kind of like one of those kinds of things, because just from the coronavirus itself, they're saying that, okay, we have this massive sell-off and drop, we get people back, maybe we have an expansion period, and then, coronavirus comes back and we got to start doing this thing all over again. And we'll probably see that up and down aspect until we kind of get to a place where we have a vaccine, or we have the ability to be able to see people that have had the coronavirus and be able to, that have the antibodies to be able to kind of go out there and not worry about getting sick. Mm-hmm. So yeah, I think that's a
very mild symptoms and just weren't feeling it. And now they're able to enter back into the regular market.
Totally.
Yeah. Yeah. I mean, there's just so much unknown. I still feel like, based on the March 2020 numbers, again, it is still a little early, but we are seeing houses come off the market. Like I said, I'm still showing houses to a select few buyers that really need to move. I think that's more of a, social respect on my part. If you don't, I kind of had, well into 10 plus buyers before this started, and over half of them, they don't need to buy right now, and they kind of also want to pull back. But there are a few that they're either relocated and they're in temporary housing and that's about to go away. Their leases aren't being carried forward. There's different scenarios for everybody. But I think just going out and seeing houses, our listings are getting great showing traction and things like that. Yes, it's down, but we're still seeing under that 300,000 mark. It's pretty hot.
Yeah, it's still really competitive, right?
Yeah. And there's just different ways too. If you're nervous about selling and then not being able to buy, we've talked about this. There's different ways to go about it. You can't door knock like you used to for your buyers, but there are a lot of expireds out there where agent to agent, we could communicate that, hey, I know this home is no longer in the market, but we got a buyer that wants to do transition to move up, and you seem to check all the boxes, and now they're kind of ready to go. Can we get in and do a one-time showing? And there's just a lot of different ways to kind of go about that. And I think too, once the stay in place order, as it loosens and things like that, the market we'll see more people back out and stuff.
Yeah, I agree.
I'm getting bored.
Me too. Me too.
Both of us, when your whole life is kind of centered around your career, if you will, and my husband and I do it together, and now it's like, okay, what do we do now?
Yeah. wait, you're still here? Oh,
Yeah.
wait.
So let's kind of just recap really quick. If someone it still is employed, still feels like they have lower DTI, I mean, it's still the market for them. They still can enter the market.
Yep. Yeah, for sure. It's not like lending is completely shut off. That's not the case. They just expanded it so much that, they realized that the economy was really good, and they realized that they needed to expand the lending requirements in order for people to help more people be able to fit into these buckets to qualify. And they started doing that because they wanted the loans, they wanted the risk. But, interest rates and mortgages, it's all risk-based stuff, right? And so all they're trying to do is limit the amount of risk that they have. And what does that translate to for individuals? And the thing is that as you're coming in, yes, you're correct that 5% down, 3% down, all that stuff's still good. You can do it. It just means that the qualifications might be a little bit different. And if you're on the border, or sort of on the cusp of whatever you could, potentially being able to qualify, how do you kind of explore that? And part of that would be able to talk to me and, other people like me in my industry that can, sort of provide that guidance as to what you could do to kind of get yourself in a position for 30, 60, 90 days. Because I don't think that these credit overlays are going to go away quickly. I think that they're going to be, and once they do, you'll know that the economy is back. But until that happens, they're going to be there for a little while. But, the thing is if you can link up with somebody that knows what they're doing and can kind of advise you as to how best to kind of structure your finances and kind of what you need to do, you can make that happen, because there's still a lot of options out there.
Yeah, I would agree. I think it's such a good time too. Like, this is the one time where the world is on pause. So what a great way to actually start to explore your options, look at speaking with a lender, talking to a financial advisor, like, where do I sit? What do I qualify if I want to move or was thinking about moving? And unfortunately, this kind of came to right before you started doing that. Now you have time to get your docs in and talk through what your qualifications are, and not scramble to do it because you found the perfect house and we need it in 10 hours so you can make an offer. Really kind of knowing your options is really great. I really think this is a good time. If you haven't spoke to a real estate agent, start interviewing them. You're around, we're around. We're less impeded by our schedules. Like, it's just kind of, it really is, if you think about it, a great time. Call me. Call me, maybe. This is no secret, but I bought a new car, and it was the best car buying experience I've ever had.
Yes.
Like, everything was communicated via text. You got to shop online. I've been fortunate because I really don't feel like I've had like a gross car buying experience, but some people really do. And I thought, you know what, this is a great time to take advantage of the market. And why not do it from the real estate side? So I really think it'd be a good time to kind of talk through your options and just educate yourself. There's a lot of different platforms. We're getting a lot of fake news. One of the things that we're trying to do is actually provide value and facts, and we don't want to pretend like it's business as usual. It's not. That's not the truth. It's going to take some time to kind of see what's actually happening. But there are a lot of different resources that both you and I can provide for people to understand what is going on in the marketplace.
Definitely. I mean, the thing is that money got really expensive there because there was so much uncertainty, but, we're really seeing a lot of lenders be able to kind of get back to a place where they're offering very competitive rates for like kind of all-time low kind of deals. And it's, the true cost of buying a house is not necessarily the fact that it would depreciate at some juncture for a short period of time, because we know that real estate has, for, obviously all markets bounce, but like that, real estate has always had this upward trajectory, right? Like, yes, we have dips, we have these, sell-offs at some point, but, the true cost of actually buying a house is the money that you're paying in interest. And if you can get that for cheaper, then you're winning, right? So you actually have a little bit better of a, your risk tolerance should be more as far as what you think that your property could depreciate by in order for you to be okay, because it just means that you're staying in the house for a little bit longer. But if the payment is affordable and the money is cheap, who cares, right? Like you have a house over, you have a roof over your head, you got it worked out. You know, it'd be a different story if you were thinking about, you know, this was happening and we were at like 5 or 6% interest rate, which is not unheard of back in the day, right? Prior to the whole, you know, collapse and all that kind of good stuff. Like, you know, you talk to your parents, you know, what they used to pay for an interest rate.
18% in the 80s,
Right.
like that.
Yeah.
Unbelievable. Yeah.
Correct. It's amazing that anybody actually ever bought a house. It's like, why would you ever do that? I'll put it on my credit card. Don't worry. Like what? 17, 18% is nuts. So it's you know, it's about saying that you actually, the opportunity cost of actually buying now, whenever you can get something around 3.5, sub 4, right? That's a huge deal as far as what your purchasing power is in order for you to be okay and secure within the context of that house, because you have the ability to have a price shock a little bit. You can tolerate that more.
Mm-hmm.
And so, yeah, that's just kind of my 2 cents as to why it's okay to buy now and what my experience would be as far as that goes. I would, you know, if you think that you're like you're going to be gainfully employed, obviously you're not going to be overextend yourself, right? Like you're not going to really kind of push the envelope, but you're going to really put yourself in a position that you feel okay, you know, whether it be just qualifying one spouse versus the other on, you know, the loan. But, you know, ultimately it's just about, you know, saying like, okay, I'm going to manage some of my risk, but, you know, ultimately the true cost of this house is actually pretty cheap.
Yep. Yeah. Especially when we're comparing to rental rates. I mean,
Yeah.
it's very expensive to rent right now.
Yeah. I mean, you look at 2-bedroom houses and you're talking, I mean, 2-bedroom apartments and it's like, oh yeah, you're paying somewhere around $2,000,
Mm-hmm.
right?
Yeah.
So it's like, could you buy a house for $300,000? Yes, absolutely. For somewhere around $2,000? Yes, absolutely.
Yeah. Great house. Absolutely.
Yeah. Yep.
Mm-hmm.
So, yeah.
Well, good. Well, I'm glad we got a chance to kind of chat a little bit. I hope to have you come back on when, you know,
Yeah, this was super fun.
It is super fun. Yeah. It's
Yeah.
nice to see your face.
Yeah. Air hug. Air hug.
Well, I really appreciate you coming on, Bryan. Like I said,
Well, thanks for having me.
Yeah,
Appreciate it.
You're a very trusted lender, and we're really great to have. It's nice to have you in our circle. So I appreciate you, and we'll definitely connect again soon.
Yes, for sure.
Okay, sounds
Have a good day.
Thank you.